the guy who has to leave early. We all jump on at 6:30 for him.
You guys jumped on at 6:30?
Yeah.
You were like, I gotta go. I got short time. We're like, well, we should get on early.
I did get on early.
It's 6:59 right now. It was scheduled for 7:00.
I told you early for him was going to be on time. Didn't I tell you that?
I think it's great. I think AJ said early. He didn't say how early.
Hey, I'm still there. Wait for it. I'm still good. I got a minute.
In AJ's defense, at least we're going to save at least 10 minutes by not having his assistant have to set up his whole mic and his sound and everything as we sit here and watch him.
Exactly. Early and prepared.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, sports fans, and welcome to episode 12 of Drunk Real Estate. Once again, I am Kyle Wilson, also known as Ashley Wilson's husband, and I'm joined by my prima donna co-host, AJ, and the rest of the gang here. How's it going, AJ?
Doing wonderful. I didn't know we were going to talk about sports, so when you say sports, are we talking like water polo? Or?
No, I keep trying to get you guys to sign up for fantasy football, and you're not returning my text. So I'm just keep throwing it out there, so subconsciously you feel like you have to.
I'm just not sure exactly how that works. So
even better, just auto draft, and you'll probably win. These days, as AI, it's just going to do a good job.
But do we have to log in to auto draft, or can it just auto draft for us without us being there? Because if it can auto draft without us being without me there, like, can it just happen and just?
Yeah, you just set it up to auto draft and you don't show up. It'll do it on its own.
But can somebody else do? AJ, can you get one of your assistants to set up you and me on the auto draft, please?
I'll get my people to take care of it.
AJ's not even going to auto draft. He's going to have one of his assistants. He's going to be like, who knows the most about football? Okay, this is your job. I'm going to pay you for an hour to sit here and draft my fantasy football team. AJ, what are you drinking?
I'm doing the Ultra Blue Monster tonight. See, it matches my shirt. I thought that would work well.
I was going to say, it matches the shirt and the blue lighting, by the way.
That's right. This was totally coordinated. I planned all of this for hours.
Nice. Jay, how's it going over there?
I'm doing well. I signed up for your fantasy football.
I saw that, and I really appreciate it. We got a nice little real estate crew now.
Yeah, I don't know what to do next. I mean, I don't really know how to do a draft, but I'm registered.
Well, I'll send out an email once we actually have everyone signed up, because we only have 9 people right now. We need 10 to play. What are you drinking tonight?
I'm going with my my daily drinker, my standard. I don't drink daily, but my weekly drinker. Let's call it Oberon Napa Cab, and just starting out. So unlike last week, I'm probably not going to finish the whole bottle.
Little slip of the tongue there. Jay drinks every day. Mauricio, how you doing?
I'm doing good. I'm actually adding. I'm tired of listening to you whine about the fantasy football, so I'm actually going to put it on my calendar right now to make sure that I get on there so I can auto draft, so I can stop listening to your whininess about the fantasy football. But I'm doing good. I am celebrating a week late. Last week was a Pinot Noir day, and I was drinking a cab. So today I figured I'd go back to the Pinot Noir and drink my daily drink that I drink once a week, and that is the Meiomi Pinot Noir.
Perfect.
We're gonna have to sync up at some point and drink the same thing.
We should. So, and let's throw it back to fantasy football whiner Kyle Wilson. What are you drinking, buddy?
Yeah. So I was I thought I had to rush to get on here because AJ had to get out of here. So I just grabbed whatever I had. So I just grabbed one of the classic, the clear.
No,
drinks.
Don't add it. Is that yours? Don't promo it.
Yeah, it's mine.
Clear. What is that?
Don't promo it.
All right, fair enough. Well, we're under a time crunch, so let's get on this so AJ could stay as long as possible. We're starting off with the 10-year Treasury because the 10-year Treasury is now over 4.3%, which is the highest since the financial crisis back in 2008. Many people aren't really paying attention to this, but I really think they should be. When people talk about interest rates, they're typically referring to either a Fed raise or a mortgage rates, but last but not least is usually the Treasury rate. And these all kind of affect each other, but arguably the 10-year Treasury has the most effect on the economy of all of them. So, yeah. Jay, what's going on with the 10-year Treasury, and how's this affecting the economy?
Yeah, we've had a crazy run with the 10-year Treasury, and let me back up a little bit for anybody that's just jumping in here and has no idea when we say 10-year Treasury, what the hell we're talking about. Let me give just a little bit of understanding of what that
By the
means.
way, Jay, between you and AJ, I'm timing your segments and how long you take to do the explanation, and it's going to be I'm going to tally it up at the end.
Okay, I'll keep it quick. So, okay, when the government needs to raise money, they do it by issuing these things called bonds. And when they issue a bond has an expiration date and a return on investment. And so, for example, the 10-year bonds, they're called notes because 10 years time period is a note, but it's a bond. And that means you buy it today and you get paid some return for the next 10 years, a fixed return. And then after 10 years, you get your original investment back. And that return is also called a yield, a bond yield. And that's basically determined by supply and demand. The more demand there is for a particular bond, the lower the yield's going to be. The less demand, the higher the yield's going to be. And so just to put in perspective what 10-year bonds normally pay, or not normally pay, but have paid in the past, if you think back to COVID, the beginning of COVID, like July of 2020, investors were terrified that the global economy was about to collapse. They thought like everything was going to hell, and they didn't want their money in real estate. They didn't want their money in the stock market. They didn't want their money in anything except the safest investments on the planet. Safest investment on the planet is U.S. Treasury bonds. And so lots and lots and lots and lots of investors, including governments, big investors, institutional investors, were taking ridiculous amounts of money and they were putting them into U.S. Treasury bonds. And a lot of it was going into the 10-year bonds. And so with all of this demand, like I mentioned, when you have a lot of demand, the yield goes down. And so people were putting all this money into 10-year bonds, and those bonds were paying less than 1%, less than 0.7% for a lot of 2020 per year. So you put $100 into a bond and you're literally getting 70 cents a year for the next 10 years. I mean, basically no return, but because U.S. Treasuries were so safe and secure, people would rather have their money there getting essentially zero than put their money into something that's higher risk. Now, here we are 3 years later, and a lot has changed. Over the last 3 years, bond rates have gone from less than 1%, 10-year bond rates have gone from less than 1% to today they're a little bit over 4.3%. And so part of the reason why that happened, the good news is, unlike during COVID, people are a lot more confident about the economy right now. People are comfortable putting money into real estate. They're comfortable putting money into the stock market. They're comfortable putting money into crypto and all these other investments. So they're taking money out of U.S. bonds. And when you take money out of U.S. bonds, the yields, the returns rise. And so that's the good news on these higher bond yields these days. Now, the bad news is there's a couple pieces of bad news. Number one, as bond yields go up, they become a much more attractive investment for investors. So if I have to choose between the stock market at 7 or 8% and 10-year bonds at less than 1%, I'm probably going to keep some money in the stock market. But as bonds get over 3%, 4%, 5%, why do I put my money in the stock market making potentially 7 or 8% with a lot of risk, or at least some risk, versus putting it into a treasury bond at 5% or 4% or 6% with essentially no risk? So as bond yields start to go up, it's going to start sucking money out of other assets. It's going to start sucking money out of the stock market. It's going to start sucking money out of real estate. So why would somebody invest in my real estate deal earning 8 or 9 or 10% with some risk when they can put that same money into bonds at nearly the same amount of return with a whole lot less risk? And so if we continue to see bond yields continue to go up, what we're going to find is that a lot of investors are going to start pulling money out of other more traditional asset classes like stocks, like real estate. They're going to start putting money in bonds, and we're going to see the stock market start to go down. We're going to see money flow out of real estate. We're going to see money flow out of venture capital and businesses. So that's one of the big risks of bond yields going up. The other big risk is that the biggest correlation between the 10-year bond and another asset class, let's call it, are these things called mortgage-backed securities, MBSs. And basically, that's the thing that drives mortgage rates. And so as 10-year treasury rates go up, mortgage rates tend to go up. And so as we see bond yields increase, we're going to see mortgage rates increase. And as long as bond yields continue to increase, mortgage rates are likely to increase. And that's part of the reason why we've seen such a big increase in mortgage rates over the last couple months. Yeah, I mean, again, the good news is that bond yields up means that there's a lot of confidence in what's going on in the economy. But the bad news is that if yields go much higher, we're going to start to see some things in the economy breaking. Nobody has anything to say about that.
We weren't really paying too much attention to it, but no. Look,
I can keep going.
No, he made it over 5 minutes there, so that's why we tuned out at 4 minutes and 30 seconds.
yeah. Look, I don't. Unfortunately, I have nothing to really terribly disagree with Jay on that. I mean, I do see these 10-year bonds, at least on the longer end of the curve, more of growth and inflation expectation. And so to your point, Jay, when things were bad in COVID, people were scared. They looked for safety. People go into treasuries. That drives the yield down. And now they're a little bit more excited. I'm much more interested. What I've been paying attention to when it comes to the 10-year is how the 10-year relates to the other bonds on the yield curve. Because if you've been paying attention, you'll typically hear something to the effect of, hey, our yield curve is inverted. You've probably heard that term before. And what that means essentially is that the longer year, the 10-year yield, for example, the longer term yields are actually lower than the shorter yields, which doesn't make any sense when you think about it. So for example, the Fed came out. We all know they've been raising rates. I just checked before coming on here. The average Fed rate over the last week is about 5.3%. So that's the overnight lending rate. That's the rate the Fed will charge the banks just alone overnight. So you can imagine if you're lending 2 months out or a year out or 5 years out or 10 years out, you would expect that number to keep going up. And that's kind of what a normal sloping curve looks like. I just pulled the numbers and it's still massively inverted. So the 1 month, for example, is 5.53. 2 year goes down to 5.05. The 5 year goes down to 4.49. And then the 10 year goes down to 4.33. Now the 30 year has gone up a little bit more. But what you'll hear about this thing is like that usually is a great predictor of recessions, which is really the macro that I'm paying attention to is the inversion of the yield curve. But the recession typically comes when the yield curve actually uninverts. So it's inverted. And so the question is at some point it's going to go back to normal. It's going to invert back. But the question is, and this is really my point, I know I've been rambling for a little bit, but the point is there's two ways that these curves can uninvert. One is that the 10-year yield can continue to go up and up and up, which is kind of more of a bullish case for the economy because that just means more people are more, they've got this growth and inflation expectation. Things are going to be great, so they sell bonds, and that for the yield goes up. Or the other way the curve can invert is that the shorter end of the curve, the 2-year curve can go down. Right. And that also inverts it. And that's the one that usually is the one that signals a recession. And typically when that uninverts that way, that's when the recession kicks in. So that's why the curves are so important because they are a great predictor of recessions. And to me, that's the number one thing I'm looking out for and concerned about is are we going to have a recession? And if so, how deep it is, the curves will give me some guidance on that.
Well, it makes a lot of sense why they're inverted right now, though, because if you look at conceptually, just the 10-year treasury is supposed to be an average of what your short-term return would be over the next 10 years. So if you take what's the shortest treasury, a month? If you take whatever the month yield is, that is 5.25 or 5.5. I don't know what it is.
5.53.
Yeah. And so if you take that and you get paid that this month, and then next month you get paid that, and then maybe it goes down a little bit, and then by the time it gets to 10 years, the market is expecting we're going to be somewhere in the threes, and the whole thing will average out to 4.3 is conceptually how this is supposed to work. But there's also that other supply and demand issue that goes on where these are auctions. Literally, you go onto the Treasury website and you bid on these treasuries, and based on supply and demand, that moves the needle on what the demand is and what these yields are going to be. And if you look what just happened, that because of the whole debt ceiling debacle, and then their long dated treasuries kind of were on freeze there, the Fed now has to release just a shit ton of long dated treasuries all at once. And they tried to step it up. They're going to slowly do all this, but everyone knows it's happening. And so the supply is going way up. And so for demand to meet that, it's going to drive the demand up as well.
Yeah, but Kyle, the issuance is certainly these days happening a lot because obviously we have the debt ceiling, so they're issuing a lot more. But this is one of the deepest markets in the world. This is not just a U.S. thing. The world trades on the Treasury, and it's not just new issuance. It's just supply of demand. People, you and I trade. I could have a bond, and I want to sell it. I sell it to AJ.
Yeah, but they're going to be issuing like 1 trillion in long dated treasuries in the next 3 months.
Yeah, but this is like this is a multiple $1 trillion market. Like the issuance on that doesn't necessarily move the needle as much, I think, as you think it does, because it's a worldwide market that gets traded not only in the United States but the entire world.
But if you increase the supply by 30%, then obviously demand's not all of a sudden going to just immediately match it. The demand, in order to entice the demand to meet the supply, you have to raise the rate. It's just supply and demand metrics.
Right, but you're assuming that on that example, you're assuming the Treasury is a $3 trillion market. And let me just pull it up while you guys finish up on what the size of the Treasury market is.
Yeah, so they're doing 1 trillion in the next 3 months.
35 trillion, $35 trillion is, well, maybe not. Let me find out I think it's 35 trillion. Actually, that might be the number of the Treasury market.
So I guess my point was, though, is just the whole idea of what the 10-year Treasury is. There's a bunch of things that kind of throw it off. And I think Jay alluded to it, the confidence in the market. So when you see something like us getting downgraded as by Fitch or the S&P or whatever, technically our yield should go up because of that. It didn't really move the needle much on just because of that. So there are all these other metrics that make it just not a kind of an average of the 10 years over the next 10-year yield.
Yeah, and keep in mind that I mentioned that confidence is one of the big things that moves Treasury yields and Treasury and bond prices, but it's not the only thing. I mean, interest rates play a huge part as well, and so the fact that the Fed is raising interest rates is going to lead bond yields to go up higher as well, simply because you now have other options. You can get money in other places, or you can get returns in other places, and yields have to stay commensurate with yields on other asset classes.
Yeah, I think when we're looking at this, for anyone that's listening to all this, this seems like a lot, right? There's a lot of if-ands, there's a lot of this and incentive base. And I think if we're trying to really boil things down and for people to understand, capital markets in general, it's like a blob of money that moves around, and it moves around to get the best return possible. And that best return is correlated with risk. So it's a risk-adjusted return. And when you're looking at principally equity, not the equity markets, but equity in general, meaning that when you're looking at equity that is driven by demand from investors, these incentives for investors really matter. So if like Jay mentioned earlier, if you're getting a 7% return on the stock market, but you're going to get a 3% return or 4% in treasury yields, don't invest in the stock market, because your risk adjusted rate of return is not, you can get 50% of your return with no risk, right? So what happens is that money starts to move. And as money moves from one thing to another, it decreases demand, which creates an equity. The stock market, for example, suffers, right? Because now you have capital leaving those markets. There's less demand, so prices have to lower on stocks to entice people. And that's the same also with real estate or anything else. So the blob of money that's shifting around, this ginormous thing of money that's shifting around through all these markets, these changes have massive implications on overall equity returns. Okay. So and this is why you see things with like business as well. Business announced we're more profitable than ever. We have better outlooks than ever, everything else. And yet the stock market keeps going down, right? It may have zero to do with the intrinsic value of the asset. People aren't buying the business. They're buying the equities. This goes around in the economy as a whole. So as this capital shifts, though, it all of a sudden kills startups and it kills the highest risk things. Why? There's no reason to invest in high risk if you can get a good return in something that is super safe or no risk at all. So there's different levels of assets that kind of get smacked. And when you're giving such high yield and debt products that have a promise, a guarantee of being returned, there's big implications with that. And what it shows is twofolds. It shows what we're having to do to price those assets to make them safer. And it also shows like where investors are fleeing towards. That's why these things are so important. That's why we're looking at it. Real world example, if I can get 5% in a bank account on a CD, I'm not giving my money to the stockbroker. I'm not giving my money to the real estate investor. Why? Because they're saying they're going to get me a 10% return annually upon a sell that they don't know will ever happen. The stockbroker is saying, well, I think we can get you 7%, right? If that too, over the long run, 3 years could be disastrous. Nobody's going to move their money out of a CD. That's not logical. And then you have large funds and pension funds. They're looking at, I got to create a good, stable return for my investors, which will be judged and benchmark on that risk allocated towards it. So these incentives are really, really big in the economy, not just the government level, not just who's issuing debt, who's buying it, right? The actual implications of this changes the way you get debt. It changes the way the businesses that you work with. It changes how your investors that you want to attract are looking at those deals. Because now they say your 10% sucks when I'm getting a 5% return.
And that's true for, you could pick any one of the dated treasuries right now. You could pick a 2-year, you could pick a 3-year, you could pick a 1 month, or you could just do a money market, which kind of does a bucket of them all. But the reason the 10-year is so interesting and important is because basically all fixed debt in the US is based off of the 10-year treasury as a benchmark, which is, it was always interesting to me to begin with that 30-year fixed mortgages are based off of the 10-year treasury. Like, why not the 30-year?
How long do you think the average mortgage is held?
Yeah, 7 years or something. Like, it's like, yeah.
And so if you have to choose between a 10-year or buying MBS bonds, which typically mature when the mortgage is sold, which is 7 to 10 years, it's basically an either or. They're comparable investments.
But then to your point, though, the how enticing that these treasury yields are, it actually works against mortgages as well, because not only does the mortgage index off of it, but then there's that spread on top of it, right? So it'll be, if the 10-year treasury is at 5.3 right now, then mortgages are going to be 5.3 plus a gap. So you have to mind the gap, I guess, is the thing of what is the gap in between. And historically that gap's like 1.75. I think it went down to 1.3 a few years ago, which was like the lowest ever. But now it's like close to 3. And one of those reasons to what you're saying is you need to have a certain spread above what you could just get in short-term rates. And if short-term rates are basically 0, then okay, your spread can be 1.75 because that's a 10x multiple over what the short-term rates are. Now, if they're over 5, you need a little bit even more to entice people to invest in commercial mortgage-backed securities and things of the like. So it's a double whammy for these mortgages. And until we see the 10-year treasury or even these short-term treasuries come down, then mortgages are in for a tough haul.
The other thing to keep in mind is that, and we talk about problems with high treasury yields, is that literally this is how the government raises its money. So when the government needs $4 trillion in stimulus or PPP money, unfortunately they sometimes do, they raise it by issuing these bonds. And so how much interest do they have to pay on this debt? Well, they have to pay whatever the bonds were issued at, the yields that the bonds were issued at. And so if they have to issue bonds at 5 and 6%, then they're paying a whole lot more interest on the U.S. national debt than if they're issuing bonds at 2% or 3%.
Right. And that's what we've been saying, Jay, right? Because I mean, back in the day, the average interest rate for the U.S. when they averaged it all was hovering around 2.5%. And that number is now 4 plus, and it's on its way to like 5. And so just, what's our debt right now? 30 trillion plus. And so at 5%, that's like, we're not at 5% yet, but if it was 5% at some point, that's $1.5 trillion a year that we've got to pay on interest on that debt. So that's a massive point that it just keeps going up and up. And it's just we've talked about that death spiral, over the last episodes too. And by the way, don't forget about, again, I want to emphasize that this is, first of all, this is obviously a super complicated matter, but it's like I said, it's an international thing, and there's so many forces behind it. But one of the things that's been happening recently too, if you guys haven't been, those of you who haven't been paying attention, is Japan has been slowly increasing or loosening their rates as well, and that has an effect on our U.S. because a lot of people were borrowing money and still were borrowing money. They're getting free money over there in Japan, so people were borrowing money in Japan and buying Treasury bills here. So when they're buying the Treasuries, yields are going down. Now some of those trades are unwinding because the Japanese bonds went from I think 0.25 to I think it's about 0.7 right now. So a lot of those get unwound, which means they've got to sell their Treasuries, which is what's driving some of that pressure up as well. So it's just a lot of different factors that are taken into account.
Obviously, as this debt rises, then we're going to have issues with our economy as well, and so. Why don't we use that as a point to pivot to Bidenomics? Because obviously it's his job to take care of this. And by most measures, the current economy is actually in a pretty good place, depending on your perspective of it. We have jobs numbers are looking great. We're seeing economic growth. Wages are now ticking back up. Inflation is back around 3%. And so Biden has kind of tried to stake claim to this. He even named it Bidenomics. Kind of after Reaganomics, is the famous one, which is kind of funny in itself because Reagan hated that term Reaganomics, and now we're getting to the point where people are claiming it. So Biden's trying to kind of claim that we're victory, early victory right now, and people aren't really buying it. If you go to the latest polling numbers, last Thursday. Americans found that only 36% approve of Biden's handling of the economy. So Biden's passed quite a few bills, economic bills, trying to fix the whole COVID thing and boost the economy and all this stuff. So why don't we go to AJ, since you've spoken so highly of President Biden in the past? Shouldn't he be getting a little bit of credit for some of this?
Yeah, I mean, he's done such a good job. So there's so much to praise. I think there's a fundamental reason why, generally speaking, the pundits that say the economy is doing good, but yet approval rating is low, because nobody feels it good. We have not seen when they say, oh, inflation's down at 3%. Yeah, but that doesn't make up for the fact that everything just doubled, right? So when you go to the store, I don't know how many, I have 3 boys. I mean, going to the store is crazy today. The prices are just not sustainable. It is shocking at how much things cost today. People can't buy cars. They can't get new houses. We have a housing basically crisis. I mean, it's pretty bad. So what people really care about, no, they're not better off. We're now at the lowest savings rate we've seen forever. Cash is being dwindled out. People are working now more than they've worked before. So people are, I think, upset about that because it's like you're gaslighting. They're going out and saying, oh, the economy is doing so great. And I think it shows that they're just wildly disconnected to the reality on the ground. And people are not doing better. People are struggling. And the reality is that these prices are crippling America. And I don't think they feel that that's been addressed properly. And the things that have been into place, I mean, when you look at Biden's economic plan, you have making smart. So his 4 pillars are centered around making smart public investments, empowering and educating workers, promoting fair competition to lower costs for small businesses, and relief measures and vaccine efforts to address COVID-19. Which includes what he says he wants to bring manufacturing back to the United States. And so we are a manufacturing powerhouse. Now, there's a whole bunch of problems associated with that. I think that it's not addressing what's really hitting home for most people. People are saying, okay, that's great. How are you educating workers, right? What does that mean? You're empowering education. The efforts on bringing manufacturing back, principally focused around discounting chip manufacturers. They pumped, huge amounts of money into that. But manufacturing coming back to the United States, how are we going to be competitive? It's like typical government fashion. We're going to try to force the economy to do something, right, that actually won't result. Manufacturing, you need cheap labor, you need cheap land, you need cheap cost. Those things don't exist in America. Like, manufacturing's not coming back to America. That means you would have to fundamentally change the inputs that drive cost, or the consumers are just going to have to pay multiples higher than they would if it was manufactured elsewhere.
What about tariffs, AJ? I thought that was the solution.
Yeah, tariffs just to solve everything. That's worked so well in the past. And so, you got this problem, I think, where what they're addressing and what they're talking about isn't hitting Main Street and isn't hitting home. And then they're coming out and trying to tell people, and they're acting like Reagan economics, which was coined, which he didn't like, but is so successful that it got coined that. He's trying to do the same thing, but people are sitting here going, it's not a success. You say it is, but none of us are getting the benefit. So I think it makes the Biden administration look very not in touch with reality. And when they go out and they're trying to tell people you're doing so well, and people don't feel that. Nobody's seeing that. And I think that's the problem.
Yeah, and AJ, as I know, you're a huge country music star, but I mean, there's a reason that country music song that's number one now that's come out over the last couple of weeks has really resonated with people, right? I mean, it's literally representing the view of so many Americans, which is like they're out there busting their butt, they're working hard, and yet they're not getting anywhere. They're not advancing. They're not doing it. And part of it, and we'll talk about it in a little bit, is just everything. To your point, everything's so expensive. Everything's growing. So even though their wages are going up, they're not going up anywhere near as fast as home prices are going up. I saw a meme today. So I don't know if it's true or not, but I mean, I just looked at sort of the interest rates on used vehicles and new vehicles. I mean, I think the new used vehicle rates are now 13% or something in order for you to buy a used car. So similar to real estate, what's going to happen with all these people? Their leases are up and they need to renew that and how are they going to afford all this stuff? It's like, it's just not.
The bottom 80% of America has had no wage growth. None. Yeah. They are negative when you count in inflation.
But let me ask you a question, and this is what bothers me is that. And maybe part of it is that we're calling it Bidenomics, which is ridiculous, because I'm not a big fan of building statues to sitting presidents, and that's basically what we're doing. But does anybody honestly believe that if Trump were elected, or if anybody else were in office right now, that we wouldn't have seen the inflation that we saw after COVID, that we wouldn't see exactly what we've seen, and that things wouldn't either be where they are now or worse? And I'm not giving Biden credit, but my point is, I don't think anybody who had come into office after Trump left in 2020 or 2021 would have seen anything different. I don't believe that anything Biden has done has truly taken effect yet. And so does anybody here really believe that somebody else could be in office right now and things would be better or different, or we wouldn't have seen inflation?
You make a good point there. Like, let's look at all of these plans that he's enacted. Like, do we think, like, is the CHIPS Act, has that really taken effect yet? Like, nothing's even been built yet. So like that hasn't affected the economy. Like, what else? The clean energy, like, has that really had any needle move on anything that's going on? This is all stuff that's from, years ago that's coming to fruition now. All of his plans are honestly long dated. He's not going to get credit for them until long after he's gone. And let's be honest, it's tough to be a Democrat right now. Like, think about the job they have to do. They have to try and do well by the economy and still support the people who vote for them. And those two things are tough. Like, you kind of have to stay, as the Republicans like say, woke, but the idealism of being woke, woke things aren't cheap is a good way to put it. Like, to AJ's point, like, like social programs, those aren't cheap. Where's that money coming from? International politics, like, we don't want to engage with China's spying on us. Let's do all this stuff. Like, that's not cheap either. If we want to take all of our stuff away from China, that's not cheap. So like all of these things that like he's supposed to, the public quote unquote cares about, he's supposed to kind of balance that with also keeping the economy strong. It's not a job that I would want.
It's hard. It's not. Well, it's not anyway. And to Jay's point too, it's like whether it would have changed or not under anyone. First of all, we don't even know. I think he's done some bad things. I think he's done some good things. But at the end of the day, I think the problem people have is he's acting like he's killing it. The guy's acting like he's the new Reagan. And everybody's looking around going, what?
I have a conspiracy theory. So I think that he's taking the win now, because if it does turn out that we have a soft landing or no recession, then he basically, like, that's a smooth sailing into the election. Like, he could just take that into, like, hey, this was an impossible task. We pulled it off. Victory celebration. And then if it doesn't work, we do have a recession. The timing was going to be shitty anyway for the election, and he could just step out and we could have a new person step in, and which is what most of the country wants anyway for a Democratic candidate. So I have a theory they're taking the win early so that it's either smooth sailing or they can get someone else new in.
What administration presided over a good economy that didn't take credit for it, whether they deserved it or not?
Well, it's the whole Trump snippet. Like, all the presidents take the same thing. Trump was always just great at calling it like it is, where you see him say,
Greatest economy of all time.
well, but no, if it succeeds, then it was all because of me. If it fails, then I had nothing to do with it. and that's kind of what the plan is going to be. You could tell that if anything goes wrong, it's going to be because of the Fed. The Fed over tightened, and that's why the economy went to shit. It wasn't Biden's problem. But if the economy's great, it was all these policies that Biden enacted.
Yeah, I mean, right now they're still blaming Trump for everything. And I think the problem that people have right now is, like you mentioned, even the song and thing, everybody feels like we're being gaslit. Everybody's tired of, like, they're going, we're being told that we should be happy, that everything's going great, but nobody feels like they have great opportunities.
But that's everyone. That's human nature. Everyone always thinks that they could be doing better. They could be doing a lot worse right now. Our unemployment rate's 3.5%. A lot of people, all those people at the bottom level, like, that would lose their jobs if we all of a sudden jumped up to 5%. They're still complaining right now. They're not looking at, say, geez, if it went up to 5%, I would probably lose my job. All people care about is how this is affecting themselves. If you look back during COVID, they did a study and they polled people about did they care more about, and they cared more about inflation than people dying from COVID. All we care about is how things affect us and how down on ourselves we are and how woe is me. And that's always going to be the situation. It doesn't matter how good the economy or if we're winning or losing.
Yeah, but right now it's way low. So you can actually gauge. It's not like they always think it's bad or something like that. That's not true at all. In fact, it's dramatically down. So people overall today feel way worse about the outlook of their individual, the country's future, of everything else. So it's when you have this disconnect to where consumer sentiment and people are saying, my life's not better, it is worse off, I don't have prospects, and then you have somebody telling them, no, it is, and you should be thanking me. That's the problem, because consumer sentiment was way better.
People don't know. People don't care what the hell. Nobody knows what they're thinking. They're doing what they're told to think. And think about it this way: how many people out there think we shouldn't be raising taxes on the rich? Most of America thinks we shouldn't be raising taxes on the rich. Why do they think that? What was that?
Rich people don't agree.
Well, rich people don't agree, but poor people don't agree either.
Yeah.
The number of people that are lower socioeconomic classes who think we shouldn't be raising taxes on the rich. Why? Because they think that's going to be me one day. Because they put themselves into this mind frame that one day I'm going to be in that group and I'm going to need to be taken care of. People don't necessarily look out for their own best interests. They look out for whatever they're told to look out for. And that's part of the problem is all of this is being driven by the media on both sides. It's not one side or the other, both sides. And people don't care about their own best interests because they don't know what their own best interests are anymore.
Yeah, but I do want to go back. We pointed this out in one of the prior episodes, but I mean, we've all heard the story, like, you know, going back to a while ago, right? Like when our parents were growing up or living, I mean, you could support a family of four and the car and the house and everything on one person's income, right? And over the years, that's eroded to the point where now you literally have to have, unless you're really at the top, you need both parents to work in order to make the same kind of, to make ends meet, like you were able to, you know, in the 50s and 60s. That's running, like, if they continue to see that there isn't a third spouse to come in and say, well, hey, if we need more money, we'll bring a third spouse into the economy to make more money. They're looking at this like, we're out of options. Like, there's only two of us. We're making what we're going to make. We just don't see any way out of this. And I get it. I mean, it has
Isn't
to
that
do
just
with
supply and demand, though? That's like, the more people have two income families, the more they're going to pay for things like houses. And that's going to drive up the price of houses. And as the price of houses drive up, then people say, oh shit, I can't afford this house. So their wife goes to work or their husband goes to work when they weren't typically working. And then that's kind of just a snowball effect.
Yeah, but the problem is they're running more and more. I mean, I don't know what the stats are, but I mean, we went through that thing 20, 30, 40 years ago, and we're running out of, I mean, now we're talking about communal. It's like now the kids are working full time and they're still living at their house with parents, so they have at least somebody paying rent and helping out a little bit there. So now there's 3 people, or it's families getting together, or it's like, 4 or 5 people getting together, because that's the only way. I mean, I see this all the time, even here in my community. Like the rents are so crazy, people can't afford to have the rents on their own. They're buddying up with other people, and it's because there's no other way to do it. The inflation is the cost of everything is so high. To AJ's point, and I still don't think AJ, do you really go to the store? Or is it assistant number 37 that goes to the store? I think it's assistant number 37. But anyway, you go to the store and you figure out what a gallon of milk and eggs and bread and the sort of the staples. And then rent. I mean, are you kidding me? Like rent's going through the roof. People can't afford houses. The car payments, and I mean, it's like.
But has Biden? I guess the question is: has Biden changed any of that, or is that just the trajectory we're on?
Of course not. Biden should not take the credit.
But he's telling us that he's winning and that we're all better off. 50% of America thinks we're in a downturn, and 50% of America thinks it's getting worse. So you have half the country that thinks we're in a downturn and that it's getting worse, and then you have a president that's standing up saying, "We won. We did it. We've got the best economy ever." That's weird.
That's why I hate politics in general, right? Because like that's the old joke. Like, how do you know a politician is lying? It's like his lips are moving. Like they're just talking, right? But I'm not here defending the prior. Like Trump was the same way. Obama was the same way. Bush was the same way. Like one of our biggest issues, which we've talked about, so we don't need to rehash, is just our national debt. And now we're seeing the consequences of that with the interest rates going up and trying to support that debt. That's not a Biden thing.
They're going to spend $2 trillion more by the end of the year. They're saying 2 to 3 trillion more.
Yeah, but Trump and Bush and Obama, they all contributed to this $30 trillion trip.
At least though, some of these, in theory, like make sense. So basically, they're doing a lot of these are CapEx spend in order to fuel growth later on. So that at least makes some sense.
Wait, what is CapEx? You're saying that we're spending money that's going to generate a return in the future? Can you please name one of those?
The whole CHIPS Act. The idea is that we're going to spend money to bring chips to be made onshore, so that later on down the road, that's going to be a plus to the economy. That's literally what it's designed for.
And you really think that's going to happen? That's going to be a plus to the economy, or is it just going to be?
Well, so that's what I was getting to. Is in theory, at least, this, the idea of borrowing to spend is a concept that all businesses use. We use it all the time, where we basically borrow money to do a CapEx improvement on our real estate.
Yeah, but that generates more revenue for you. This stuff doesn't generate any more revenue. We're just spending money that we don't have.
Well, but in theory, that's what the CHIPS Act should do, right? So if you look at the country's revenue, the GDP, so theoretically, we spend the money to bring the chip makers onshore, and that once those chip makers churn up and they start spewing out their chips, that's going to increase our GDP. So at least in theory, that's a better use of money than a lot of these other things that previous administration have spent on.
Yeah, well, remember, GDP is not revenue, right? Revenue is we have $3 trillion in revenue from our taxes. That the GDP is not, it's the size of the economy, not the revenue that we're getting, because we're only pulling in 3%.
Yes. The country is not an investment company. The country should not say, we're going to tax all of you guys because we're going to make bets on the economy to see what wins. That's not the role of the government. It shouldn't be doing those things. In fact, that's actually where we got into trouble. Why? Because they say things like, hey, guess what we're going to do? We're going to bring manufacturing back. So what are they going to do? They're going to give billions and billions of dollars to corporate America that's going to make a lot of people astronomically wealthy and will never trickle down. Why? Because nobody's going to pay double because it was manufactured in America. So instead then, they're taking out of taxpayers' dollars to give to corporations. The country should never be an investment arm. It should not be doing that. It shouldn't be saying, we're going to give a Taiwanese company in partnership with America $5 billion, or in Arizona's case, $50 billion. And two, what they do with it is very loose. That is completely opposite of the role and responsibility of a government. They shouldn't be generating a profit, right? That's not how it's supposed to work.
Let me ask you a quick question here, because do you guys think that maybe what's happening too in terms of that sentiment you were talking about, AJ, is that people are starting to because remember inflation, we haven't had an inflation problem since the 70s, right? So a lot of the millennials, they weren't around I wasn't even around really for that. Do you think people are starting to realize that, hey, the more money we print and we get all this money out of thin air, supposedly, it's all this free stuff, and we spend all this here and there, that at the end of the day, that comes back to bite me in my own pocket, because now inflation's taken on and everything costs more money, and they're starting to see that correlation a little bit more, because we've never had experienced that before. Now they are. So now when the government's talking about, hey, we're going to borrow another trillion or 2 trillion, it's like, well, where are we going to get this money from? And they're realizing it's inflation.
I saw a poll that said something like 35% of Americans literally think that inflation is caused because corporations are gouging people. That they actually believe that. They believe that's why we have inflation.
It's part of the reason we have inflation.
No, it's not. It's part of the $5 trillion. If the $5 trillion wasn't put in the economy, we would not have inflation.
Whoa. We put, how much did we put in between 2008 and 2012? And how much inflation did we have between 2012 and 2020?
Yeah, that's because it was covering up a loss. So in 2008, we had a debt crisis. That means we eradicated trillions of dollars. So there was a financial hole. So what the trillions of dollars came to stabilize markets. What we did is we put $5 trillion on already compounding capital. The inflation is directly tied to a 35% expansion in capital. It always has been, always been.
But to Jay's point, though, it is a bit of a contributor, because that money could have, trickle down economics, right? The concept of what Biden's trying to say, the opposite is, okay, we're doing the trickle up, but the trickle down economics is, okay, these corporations get the money, they spend in R&D, they do all these things, and it trickles its way down. But to Jay's point, instead of doing that, corporations took all this money and just lined their pockets. So it is a bit of a reason that the inflation happened.
Well, then hold on. How many corporations' margins got bigger? See, this is the problem, because they're saying that they're taking advantage of inflation, but they're not also getting hit by it. That's not true. Wage inflation is killing corporations. It's their number one driver of expense. So because they could increase products, a large majority of it is trying to offset inflation. So yes, I'm not saying that it's not. Like, I'm not saying that corporations didn't take advantage. Of course they did. They're going to. That's their job. It is literally to extract as much money as they can out of you. They would not have the opportunity to if $5 trillion wasn't pumped into the economy. I'm not faulting them even if they did. That is their job. It's to get the highest price. That's what I'll do. I'll do it too. That's my job to my shareholders. If you're not, you are a bad business owner.
Okay, so you're a little bit off there, because I just looked up corporate profits from COVID. And from 2020 Q2, so when COVID hit, to 2021 Q4, corporate profit margins were up 53.9% as compared to 11.4% of the average of 1979 to 2019. So they did line themselves quite a bit.
Well, that's probably primarily because of all the grants they got from the government on this PPP money. Those were all just free money.
Yeah, I'm like, hold on. That's you're stating one thing and saying that it's because they charged a customer that.
I'm just saying their profit margins went up a lot.
Yeah, I mean everybody's did during COVID. I mean, COVID was the biggest asset boom in the world.
Not everybody's. But that's the point. If they could choose not to just cash in all those profits, they could have spent it on other things like we thought was going to happen.
No. If you can extract that money and you're a corporate owner, I would be so upset if I invested in a company.
Oh, I'm not saying I would do the same thing. I would have done the same thing, but it is a contributor.
Yeah. So it's crazy to say that it's their fault. It's crazy to say though that it's their fault.
So we're acting like the consumers are dumb because they think that corporations played a big part in the inflation. And while that wasn't the number one, like that wasn't the top line of what created the whole thing, that was a contributing factor.
No, I don't think it was a contributing factor. It's a result.
According to the Economic Policy Institute, which is a bipartisan think tank out of DC, which is respected by both sides of the aisle. So it as far as I've always read, neither side claims that they're partisan one way or the other. They came out in March and said 30% of inflation was driven by corporate profit taking.
Could they have that? This is the thing. You're saying it is. I'm not arguing any of that. What I'm saying though is if you didn't pump $5 trillion into the economy,
Agreed.
you wouldn't have been able to gouge.
Yeah.
100%.
So once again, it is caused from the $5 trillion.
And don't forget the supply constraint. It's also the supply constraints, right? It's also the supply constraints that were happening during that time as well. I mean, that's what a supply and demand.
Yeah. Because normally, if you have a contraction, what's supposed to happen? People are supposed to be laid off. You have an actual downturn. So demand lowers. We oversupplied capital in a market that was not set up to handle it. We were supposed to be in a recession.
Yeah, and we all agree on that. So let's get back to the topic of, okay, so after we know all that, inflation basically was caused by pumping in all this money, but now we're years later. Is Biden doing a shitty job with the economy right now? I guess is the question, or was it just that one instance that is?
I don't think he deserves either the credit or the blame. The only part I could blame him a little bit was there is a decision on the wars, right? So the Ukraine war, that's a policy that we could have gone either way, and that certainly has disrupted supply chains, has increased the price of oil. We've had to drain our oil supplies, and I don't know if those are ever going to come back. But and we all know gas prices are a major contributor to long-term inflation anyway, because everything goes up from trucking to everything else. So that's the only thing. Other than that, I wouldn't give him the credit or blame for anything, to be honest with you. I'm not sure how much he's really doing.
Here's the other thing to remember. AJ talks about, and I 100% agree with him, that at least 50%, and I would say it's a lot more than 50%, are feeling pain right now from the economy, are struggling from the economy. But in my opinion, that's a natural fallout from pumping money directly through PPP and stimulus. And it has nothing to do with Trump. It has nothing to do with Biden, or maybe it has to do with both of them because they both did it. But the fact of the matter is capital is going to flow to the wealthy because the wealthy can put it to work. They have their basic needs covered and they can take that extra capital that they get and they can put it to work. And so all this money that flowed into the economy at the end of the day flowed to the wealthy. And this drove a wedge through the middle class. And what we saw was a massive expansion of the wealth gap. And we have this few percent at the top and most of the people at the bottom. And the gap between them is the largest it's been in ever. And so what we're seeing right now is that, yes, there is a very large percentage of society that's struggling despite the fact that the economy, purely by metrics standards, looks pretty good. Then there are people like the four of us. I don't imagine any of the four of us are going to say that since Biden took office, we've been struggling or our businesses have taken a big hit. I mean, obviously things have happened, but
it was great till a year ago.
We're in multifamily, my friend. Even storage.
Well, yeah, but
our apartments went down by 20%, but that was
we're not struggling. Jay's right. We're not. And dude, that's the problem. When governments print money, it goes to asset holders. There's a direct correlation to printing of money and asset inflation and the rich getting richer. When government sends money into the economy, and people are like, "That's wrong." How's it supposed to happen? Where do you send the money if you don't send it to the businesses that have to hire people? The economy takes the money in. So if you get a paycheck, you spend your money on things. That goes to business owners. If you increase that money by double, those businesses get double. It's a natural phenomenon, but when printing money does that, and that's why it's bad.
Well, we could spend it on better stuff, I guess. Is like if we're going to spend money, we could spend it on infrastructure and stuff like that, where we're actually going to get a return on our investment. But
here's let me end with this one thing because I know you want to move on, but I think this is important. A lot of our beliefs on how our president or the administration is doing boils down to where we believe the welfare should be flowing. Both sides of the aisle, I think it's pretty obvious, are in favor of welfare. One side of the aisle is in favor of welfare for the rich, tax breaks and legislative loopholes that allow wealthy people to accumulate more wealth. And the other side of the aisle is all about welfare for the poor. And depending on which side of the aisle you fall on, what your politics are, where you believe the welfare should be flowing, you're probably going to believe that anybody that's enacting policy that is providing welfare for the side you don't want to receive welfare is doing a horrible job. And anybody that's enacting policy and providing welfare for the side that you want to get welfare is doing a great job. And it really is that simple.
I disagree.
Yeah, you're opening up a can of worms there, Jay, that I do not want to touch. So we're going to just leave it at, if Biden's taking claim to the economy right now, if there's a recession, that might be a bad play. But if it works out, it might work out for him. So let's.
We're going to revisit this at some point because I want to know. I want to know what about that statement that I thought was so obvious you guys disagree with.
Yeah, that's so. Let's move on. We're going to talk about some precious metals here. So historically, precious metals were kind of looked at primarily as like a hedge. Actually, we're getting the signal. AJ is leaving us. We'll see you later, buddy.
Boys, appreciate it. As always, you guys are the
1 minute
best.
early.
See you, AJ.
See you, bud. Historically, precious metals were looked at primarily as a hedge of your bets against certain tumultuous things happening in the economy. Something like times of uncertainty with recession was coming. It looked like it was a hedge against a recession. It was a hedge against inflation. It was a hedge against devaluing of the dollar. But the last few years, the price of gold and other precious metals have kind of broken away from this, safe haven, as you would say. So, Mauricio, what do you think the role of precious metals is in the economy right now?
Yeah, I don't necessarily agree with that statement. I mean, I think people, when it comes to figuring out precious metals, they kind of like to cherry pick their time frames, and in the last 2 or 3 years, maybe it hasn't done great, but if you want to look at gold, for example, bottomed in 2016, just over $1,000. I mean, it doubled in 4 years. But again, I think gold is something you want to look over generations or decades as opposed to quarters or years. But what I really wanted to turn this discussion, because I think it'll be a fun discussion for everyone, and I'd love to get your feedback on this. But it all stems from a little newspaper article we saw, which I wanted to share with everyone because I thought this was just a great example of how precious metals really operate. And for me, it was like a thought experiment, which I love doing. So I think I saw this on Ken McElroy's Facebook page at some point, but it was an article or an ad for a piece of real estate. I think it was 1953. So it's about 70 years ago. And everybody was commenting on this because it was literally a 2-bedroom, 1-bedroom bath. I'm looking at a newspaper article that has a 2-bedroom, 1-bedroom bath. I'm sorry, 2-bedroom, 1-bath house that sold in 1953 for $7,450 with a monthly mortgage payment of, actually more than, it's just a monthly payment of $47 a month because that includes principal, interest, taxes, and insurance. And as soon as I saw this, the first thing that came to my mind was everybody was like, oh, wow, real estate has gone up so much. I mean, the average price now, I think, is what, $300,000, $400,000. And all I could do is this thought experiment in my head. And I said, you know what? If I had, instead of pricing everything in dollars, if I actually just took gold back then in 1953, I would essentially have needed or would have been able to trade 213 ounces of gold for this 2-bedroom house. So 213 ounces of gold back in 1953 would have bought me this house. And I was arguing, at least in my thought experiment, that the house is actually cheaper today, which I think is true, because if you had just held on to those 213 ounces of gold, those today would be worth about $415,000, which arguably it's a little bit more than the median, household that you can get today. And I would argue, looking at this, if you guys are looking on YouTube, by the way, if you're not watching this on YouTube, we do this on YouTube, and if you are watching it, subscribe if you would. But this looks, Kyle, this looks like an 800 square foot, like it's sort of a below average home today. So I don't even say it's a medium thing. But that's where my brain goes. This thing cost 213 ounces of gold 70 years ago, and if I had the same 213 ounces of gold, I could probably get a better house today. So if you price things in gold or precious metals, I would argue this house actually went down in price. And I like to play the same thought experiment with the monthly payment. The monthly payment was $47.92. That translates to about $2,600 mortgage, which is probably, again, if I had $2,600, I could probably get something better than the median thing. And so that was kind of an interesting thought experiment. And then I'll take it one step further here, guys. And you know, I love this example of my little. I got two little quarters here, right? Two quarters in front of me. If you look at the price of a gallon of gas back in 1964, I could buy that with this quarter. I could walk into a gas station, buy a gallon of gas with this quarter, maybe a little bit more because gas was, I think, 30 cents a gallon. So this is only 25 cents, obviously. But I could walk in today with the same coin and buy a gallon of gas, because this is actually a coin that was in 1964, which means it was actually made with real silver. And so this is about $4, depending on the price of silver, but it's about $4 or $5 right now, the value of this same quarter, which is about a gallon of gas. So my point is, if you look at things in the long run, you'll notice how precious metals, again, it's not meant to make profits. You know, we like to say an ounce of gold is worth an ounce of gold. People like to price things in dollars, but the problem is dollar is a depreciation asset. It loses value. Unlike this quarter that has retained its value, this quarter, which was printed or minted a year later, has no silver. And of course, this doesn't have as much value as this does. So it's lost a ton of value. But the main point I wanted to make, and this is one of the issues we were talking about a little bit before as well, and then I'll let you guys comment here, but you know, the problem is not so much that the price of this house has gotten cheaper, or maybe, you know, when compared to gold, but the main issue here is this, right? So I'm showing a graph for those of you who can't see it, but it's a graph that shows the growth in the median household income from, this is only back from 1965, so not as far back as 1953, but you can, you know, again, don't get caught up in the numbers, but you can see how the median household income is kind of hovered around, you know, I presume this is adjusted for inflation, because it's kind of hovering around zero for the longest time until basically the last decade, and it's gone up a little bit. But the average home value has gone through the roof. It's like, you know, over 100%. And the issue that somebody was very astutely pointed out was that back in 1953, you could buy a house with basically a third of your income. Like your income back in 1953 was your average income was $3,200. Right? So at $3,200, you could buy this house for $7,500. It was a little bit more than twice your salary. Well, today, as we all know, average incomes are about 70, 75 grand. So double that would be 150 or 180,000. But of course, the median household has gone way higher. And so that's the point I really wanted to make with precious metals. It really does show you that, again, it's just a thought experiment that I love having. I love pricing things in other than dollars, because I think it opens up your eyes to a lot of things. So why price something in dollars? Price it in gold, price it in barrels of oil, price it in bushels of wheat, price it in something other than the US dollar, and you'll see a pretty different picture than if you price it in dollars, which is such a depreciating asset that people are getting paid with this depreciated asset. They're getting paid more of this, but the depreciation is happening much faster than the rate at which people are getting their increases, which I think goes to contribute to the issues we talked about in the last segment, which is there's a reason why people are feeling disenfranchised. And it's because even though their salaries are going up, they're nowhere near keeping up with the cost and prices of things like houses and just, you know, day and day food. So to answer your question at the beginning, Kyle, I do think it does hedge against inflation. You just have to look at it more in terms of decades or maybe even generations versus how did it do in the last year or 5 years, because you can cherry pick that through history. But I still think it's a great hedge, and not just gold, anything of real. So that's why real estate is such a great asset, because it's a hard asset. It doesn't depreciate like a piece of dollar.
That's why I keep Beanie Babies in a drawer behind me.
Is that right?
How are they doing?
I have no idea.
My Cabbage Patch dolls. That's a hard asset, right?
I mean, yeah. If you look at it the long term, yes, it was a great hedge against inflation, but it's hard to. I mean, if you're only buying gold for the long term, yes, like you can argue that historically it was, but if you look at the last 5 years, then it's kind of moved off that, where it's, you know, if you look back in 2019, like gold went from, what was it, 1,200 to like 2,000. There was no inflation. So like is it a hedge against that? I don't know. Is it a hedge against a recession, which historically people always said, okay, people run to safety in times of recessions. I don't know. It seems like it's becoming a bit of an asset that people invest in when they have money. It's like, you know, if you have money to put places, then one of those places is just gold right now.
Yeah, and I think that's just a way of thinking of it, because I don't think of precious metals as an asset or as an investment. To me, it's like insurance. It's just how I hold my reserves. Because again, if you just look through, I always like to do the experiment of when I started working at a law firm. Like I made a pretty decent living even as a first-year lawyer. But if I translate that into ounces of gold, and I graduated, I started working as a lawyer in 1999, so it's been 20 some odd years. If you paid me in gold back then, dude, I was making so much more money compared to what I really was making, because again, gold is just, I mean, from that time, gold was like $200. It's like 10x if you went all back. So you can cherry pick all you want, but in the long run, over decades, if you fast forward, well, this was a 70-year example of the real estate, but remember, 70 years from now, real estate's going to be, what do you think the price of real estate is going to be? It's going to be like, this house that we're looking at was 7,000. It's going to be like, oh, the cheapest house on the block is going to be 1.5 million or maybe 5 million. And yeah, the minimum wage might be $1 million an hour, but who cares? It's really, what does that purchasing power do for you? What can you buy with that salary that you have? Back then, you could buy 1/3 of a house. Today, you can buy 1/10 of a house.
You made a good comment there with insurance, because that's how I look at it as well. That's kind of, I own a bunch of physical gold. Pretty sure Jay does too. I don't know if you own any. And I look at it as kind of a alternative to holding cash, in that it is a bit of an insurance policy against certain things possibly happening. Like it wasn't necessarily a good investment because gold was over 2,000 when I did it, but I went and bought a bunch of physical gold when the war in Ukraine happened. Because if you talk about counterparty risk of, it's never been a 0% chance of us going to World War III, but it was much higher then. And I wanted to have some gold because you never know in a situation like that. We did an episode on the fall of the US dollar. We agreed that it's probably not happening in the next 10 years, but it's not a 0% chance. So that's another risk. So it's not like I have like half my portfolio in gold. We're talking maybe like, 5% in precious metals in general between gold and silver and stuff like that. But at the same time, it's an insurance policy that, theoretically should keep going up with inflation. And if it doesn't, I'm okay with that because I'm mainly doing it for the other benefits.
Yeah, I mean, again, I agree. I mean, I use it as kind of reserves. And so I have some cash too, but if you're holding cash, that's losing value every year, like 9% at some point. I mean, this year it might end up being 6 or 7% that you're going to lose for this year. And if gold is down 1% or 0, you're still doing better off holding that.
And it's almost as liquid.
Yeah. I mean, I actually, there's a little bit of an investment there. If you're trying to hold your 30-day or 60-day emergency fund in gold, that's where the price fluctuation can happen. But if you're holding it, you're going to have it and it's going to be passed on to generations, or you're going to hold that and never really plan to touch on it unless something catastrophic happens, like you lose your job or whatever, then, having it in there for 10 years probably helps out.
Yeah. And I mean, it bothers me when people talk about precious metals as an investment. I mean, sure, if you want to think of it as an investment, but history has proven that it's not. And we can talk about, what if you would have gotten paid in gold back your first year of working as a lawyer? Well, what if you would have gotten paid in Bitcoin? Or what if you would have gotten paid in houses? Or what if you would have gotten paid in stock? I mean, all of those things would have held their value actually better than gold relative to the dollar.
Right. But that's my point. The point is that the dollar is such as we all know, a dollar just depreciates in value so much. I mean, even if it's at 5, even if it's at 2%, think about that. Over a 20-year period, even at 2%, you're losing 25, 30% value, right? So that's how I think I would look at it when I'm trying to compare it. It's like, again, and to me, it's most, like I mentioned, it's just a fun, I just want to encourage people to have fun thought experiments, right? Like I was watching a couple months ago, it was like some black and white movie and Babe Ruth was an actor playing Babe, or maybe it was Babe Ruth who was a cameo. And he was talking about how he makes, $300 a week or $600 a week or whatever it was. And so I would just like to, what was that back? What was the price? How do I convert that into gold to kind of make it seem like, in today's dollar? It's just a fun thought experiment for me. And I would just encourage, if it doesn't have to be precious metals, like literally barrels of oil, bushels of wheat, just price it and just as an exercise, price it in something other than dollars. And I think you'll be surprised to see some of the results and what prices really are.
The best correlation I ever saw was someone said, okay, how much did a custom suit cost back in, it was like the 1920s? And that was 1 gold piece, right? 1 ounce of gold.
Well, they say that back in even in 2,000 years ago, right? That's the example I hear, but.
Right. And so now, how much does it cost if you wanted to go and get a custom suit? Well, it's about $2,000, which is the same as the value of gold. So that's
I've heard that too. It's kind of like there's suits that are $5,000 custom, 10,000, and some of them are like $800. Like you could really play games with that one, I think. But
they didn't have your Gucci suits back then, so it was just a.
They had better than Gucci suits, man. Come on, dude. I don't even wear suits anymore.
The thing I love about gold and silver and precious metals in general is that they aren't correlated with anything except other precious metals. So the stock market going up or down isn't necessarily going to drive silver or gold up and down. Currency going up and down with some very specific exceptions that are probably more correlation than causation. Currency movements aren't going to impact gold and silver, and real estate movements aren't going to impact gold and silver. So it is.
But hasn't it though? Like that's I guess that's what though at the beginning that I made the comment like. Gold's as the stock market's been going up, the gold's been going up too. So is that
it's so yes, but it's coincidence historically, and maybe things have changed over the last couple of years. But historically, there has been very little correlation between gold and silver in the stock market.
But it does have some correlation with currencies because, people complain about how gold wasn't, like to your point, Kyle, like, oh, it hasn't really been performing. Why don't you price gold in, Argentine pesos or, what are some of these other currencies that have been crashing? Like, I'm blanking on the European country that's like just in Turkish, the Turkish lira. Why don't you price gold and look how gold is doing in Turkish lira? It's going through the roof because that currency is just going to what. So it does relate somewhat to your own personal currency because when the dollar's strong, the price of gold compared to dollars, just like when a barrel of oil is strong, then the price of gold priced in barrels of oil changes, right? But again, I don't look at it that way. I look at it as an ounce of gold as an ounce of gold.
Yeah, other countries obviously agree with you because if you look at China, like China has this gold buying, like this secret gold buying program that no one really knows how much gold they hold. Like they obviously report how much gold they hold, but if you look at how they buy gold, they actually, I wrote this down, they actually buy gold abroad with US dollars through like subsidiaries because monetary gold is not considered reportable by international customs. So they could basically go out buy the gold and bring it with US dollars, bring it back, and no one knew that it happened. And so then they report, oh, we have this much gold, but then all of a sudden they'll just release something like, oh yeah, we now have 600 tons more. Well, they didn't just buy 600 tons the night before. Like
100%. They do it all the time. Yeah. Everybody knows that the China gold reserves are way more than they're reporting. And there's an argument to be made that, hey, look, if central bankers are buying and they have turned net positive over the last few years, there's a reason for that. Like, why are the central banks buying the gold? And there's an argument that at some point, whether it's your BRICS that you're excited about, or whether it's at some point, if the system does end up collapsing because all these currencies go lose value, will gold have some role in the new monetary system? And the central bankers seem to think that having gold in their portfolios is important for some reason. So,
and that's the thing. I find it funny because there is very little intrinsic value in gold. In silver, there's some more because it has some technology uses. Other precious metals actually have a lot more intrinsic value when it comes to uses in technology. But for some reason, gold has always been the shiny object that everybody seems to love, and we're kind of saying that because
there's no other, because it's really a free market. That's what's evolved over the 5,000, 6,000 years. They try to do cows. That didn't really work. They tried to do all kinds of different things, and they found that gold kind of met all the requirements of using something that they could use as a medium of exchange and a store of value much better than a cow could.
That's because you have to feed cows, and they don't like standing in vaults.
And you can't break up a cow in one. Give me 1/100th of a cow. You can't do that, right? But you can, anyway. All right, Jay. Kyle, I'm sure you've got some not so fun games you want to share with us today.
Yeah, well, I just to finish that off, I'd recommend that everyone take a look at possibly adding a little bit of gold to their portfolio. As we mentioned, it is a bit of an insurance against possible things that could happen out there in the economy and the world. So take a look at some options.
And if you want to go to my website where I sell gold, No, I'm just kidding.
Yeah, and just to make the legal disclaimer, Kyle is not an investment advisor. Neither does he play one on TV. But that's
No, that's why I said take a look at it. I didn't say you should do it. Fair enough. All right. As Mauricio said, we're moving on not to the games, but to the top 10 first.
Please tell me it's not fantasy football. Please tell me it's not fantasy football.
It has nothing to do with fantasy football, and I wanted to have our Biden love and AJ involved in this, and he also defended Trump the last time. So, but I'm going with approval ratings since we discussed approval ratings, and so we're talking about the highest and the lowest approval ratings at any time in their entire presidency by any poll whatsoever. So it has all the different polls or whatever. And so which one you want to do? Do you want to do top 5 of highest and lowest, or you want to do top 10?
I know George W. Bush had a really low. He might be like 2 or 3 on the list.
Okay, so which one do you want to start with? Low? You want to start with low?
What does Jay want to do?
It's all, I'm guessing either way, so it's all the same to me.
So all right, since you mentioned it, lowest approval rating on record was George Bush. 19% was what he got down to in 2008. Truman got down to 22% in 1952. Nixon, 23% in 74. Carter, 28% in 79. And then rounding out the top 5, guess?
Trump? Didn't Trump get pretty low? Yeah.
Trump got down to 29% approval rating in 2021. Just barely edging out George H. W. Bush. And then just for reference, Biden's a couple more down the list there. He got down to 31% back in 2022.
There's still time. There's still time for old Joe.
So we want to go back to now let's go to the highest. Who do you think the highest is?
How far do they go back?
So they go back to there's what here, 55.
I want to, I don't know. I mean, I want to say Reagan in 1980 after he got all those, the hostages released. I thought he was a pretty popular dude.
You'll never guess who the highest was. Yeah, so we have Truman. Truman was 45, so it obviously goes all the way back there.
Obama was over 70 at one point.
There was one at 92%.
FDR?
The exact same as the lowest. George W. Bush had a 92% approval rating in 2001, and then had a 19% approval rating in 2008. There's a couple crossovers here because so George H.W. Bush got up to 89%, so the Bushes are just dominating. But then Truman got up to 87%, but you'd remember he was also the second lowest at 22%. Roosevelt, 84%, Kennedy, 83%, and then Lyndon B. Johnson at 80%. If you want to look down.
LBJ was 80%.
Yeah, LBJ got up to 80%. His lowest, though, was 35.
Is it Roosevelt or Roosevelt? I always keep hearing different pronunciations.
I always said Roosevelt.
Pronunciations or pronunciations?
Just for recent, Obama got up to 76, Clinton got up to 73, Biden got up to 63, and Trump had a high of 49%. Interesting facts there. So if you want to go the loser of the highest.
If you care about the economy, Clinton deserved to be higher.
Okay, fair enough. I had a question queued up, but I wanted to know AJ's answer to it. So I'm going to switch it up real quick, and I'm just going to do a quick question with, what is the most money you have lost on a single deal? Mauricio, you got or deal or investment?
Over a mil. But that was just a full on scam. But yeah, 7 figures.
7 figure. Jay, could you top that?
Beat that, buddy.
I absolutely cannot. Lost $55,000 on one deal that I split with somebody else. So $27,500. That's okay. That's not actually true. I guess I probably lost a little bit more on angel investment, business investments, but we're still in the 50K range.
Yeah, so I think you were in on this one too, Jay. We did have a one apartment where we went on DD, and we got pretty far into DD, and we spent a lot of money into DD before we found some things out that we decided, hey, it wasn't it wasn't great for our investors, so we pulled out. So we were in the six figures into that one, well into the figures. And we had to eat all those costs ourselves because at that point you're raising money and you're not going to pass that on to investors. So we, as a company, had to eat that. So you had a big chunk of that one too. So
That's a good point. Yes, you are correct.
that's the cost of doing business, right? You're going to have some wins, you're going to have some losses. And I guess that
We took the loss so our investors wouldn't.
yes, that's right. It's a good selling point there. We'll take the L's for you.
Yeah, if you make money, you get to keep it. If you lose money, Jay and Kyle will cover you.
It does not say that in our PPM, though.
Yeah. Make sure that doesn't say that in our legal docs, Mauricio. Jay, let's start with Mauricio. You got anything you want to plug this week?
I am going to keep plugging my Real Estate Syndicator live every Wednesday, 4:30 on YouTube.
Jay?
I'm gonna plug this show again. Go to YouTube and subscribe. Go to whatever podcast platform you listen on and hit the like button. Leave some comments. Tell us how much you love us. Mauricio, you had a couple people that put a comment on YouTube last week asking for your due diligence checklist. So make sure you check out YouTube and send that out.
We also had one suggestion for a host for fill in for AJ when he
Yeah, what was that? Who was that?
Steve Lloyd.
Steve Lloyd, good buddy of mine. I might ask him.
Yeah, so he did. Steve Lloyd did a previous podcast episode with us, and he had us on his boat. So we did the whole episode.
That's going to be the prerequisite. If Steve can fly us out, and then we can do the episode on the boat, I'm in.
Well, Jay doesn't even have to fly out. Jay lives down the street from him, so we would just have to fly out to see them. But yeah, maybe we should do that. Yeah, and to Jay's point, check out our shorts too. People, we're working hard on those shorts, and we're trying to get the views up on that. So give a little like on some of our shorts that we're pumping out. And as always, I want to plug my wife twice because I didn't plug her last week, so I'm going to plug her twice in one night. So go check her out on Instagram and check her out on YouTube as well. Badass Investor. So yeah, I don't know about you guys, but my drink is gone. I got to go hit the head as well. So I will see you next Tuesday.
See you guys.
Late.